Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are running through the January 2025 property market update. Stay tuned. We've got plenty of slides, plenty of data, and we'll run through where every market sits in relation to the 18-year land cycle. So to kick it off, I'd like to start with the Australian CoreLogic dwelling month-on-month house prices. We've had a net zero gain for the month, so flat month for the entire market. So if we dig under the hood a little bit deeper, it'll consist of, for the month, Sydney softening by 0.4%, Melbourne softening by 0.6%, Brisbane up by 0.3%, Adelaide up 0.7%, Perth up by 0.4%, Hobart flat, Darwin up 0.6%, Canberra down 0.5%. So combined capitals down by 0.2%, and the combined regions up 0.4%. So nationally, flat market. So not every market, there's not one property market, there's every market, and even every type of property within each market has its own time in the sun, which I'll show you in these coming slides. But this is a bit more dig deeper. As you can see, we have Brisbane, Perth, Adelaide, and Darwin in growth phases and their respective regions. So regional WA, South Australia, and Queensland are still on the run. Typical for the second half of the cycle, these smaller metros and their respective regions tend to have strong run in the second half of the cycle as people have now decentralised out of Sydney, Melbourne, and out of New South Wales and Victoria. It's not just a coincidence. If you look at 30 plus 40 years of sales data, you'll see the same pattern happened post the dot-com bust in the lead up to the GFC in 2007. So between 2000 and 2007, similar markets, these markets as Brisbane, Perth, Adelaide, along with their respective regions, had that solid run as we are in that similar point of the cycle. Meanwhile, Melbourne and Sydney were softer, stagnant in the second half of the cycle currently and in the prior cycle, and will continue to do so, but are coming to an end and will be the leading markets with the years ahead. So we use this 18-year land cycle as a framework to work out, firstly, where do we sit in the market at a macro level. This is called the 18-year land cycle, but also known as the business cycle. 18 years, I mean, some people like to go down to 18.6 years, but give or take, over the last 200 years, the cycle's never been less than 17 years and never longer than 21, and on average around that 18 years. So the current cycle started around 2011, 2012, 3 or 4 years post the GFC. First half of the cycle, Sydney, Melbourne outperformed. In the midsection, people then decentralise out of Sydney, Melbourne, and then enter the regions in their respective regions. They then perform in the midsection, New South Wales and Victoria, that is. People then get fed up with New South Wales and Victoria, it becomes too dear. People then start to spill over into the smaller metros and the smaller regions, such as Brisbane, Perth, Adelaide, and their respective regions. That's when they have a solid run in the second half of the land cycle or the business cycle. What we are seeing to date, and this is globally, so this isn't just Australia. You'll see what's happening in the States. People are decentralizing out of the likes of LA into the smaller markets such as Texas, as well as New York. Everyone's fed up with the prices, how high the prices are and how those cities are so expensive to live in. So they decentralize from those markets and head down to the likes of Florida, into the smaller cities that have better bang for buck. And then in the second, later half of the cycle, that's when those smaller metros and regions perform. So it happens globally. This is the framework. We use it to work out how we sit in the market and how each submarket are performing as the cycle plays out. So keep this in mind. We own the blue marker about 18 months to 2 years away from when the market's due to top out. We'll then enter the next land-driven downturn, which will be the likes of the 2008 GFC or the 91 recession we had to have, or 1972, if you recall. But every second one's a big one. So we pretty much sailed through the GFC in Australia. China had a very strong economy back then and was stimulating their economy a lot and was demanding a lot of Australian raw materials such as iron ore, coal, gas, which propped us up through the GFC. This time around, the Chinese economy is not as strong. The property market is weakening. So this one around will be a big one. Will be like the 91 recession we had to have. So every second one's a big one. The next one is due to be a big one. So keep that in mind. But we sit on the blue marker, equivalent point of time, 2005, mid to late 2005. So as we go through these now submarkets and the 20 years of sales data, look where we were at in 2005 and onwards, and that will paint a picture of where each of these markets could be heading based off history and the 18-year land cycle. So without further ado, we'll kick it off with Perth. As you can see, Perth bottomed out in 2020 and started its bull run. Every man and his dog's ploughing in, as that typically happens once a market kicks into overdrive and all the fear of missing out rushes in. All the stupid money, I like to say. It's away the races and will continue to do so, like what happened in history between 2005, equivalent point of time, mid-2005. So this leg up is looking pretty similar to what has been experienced last year. So it's only a matter of time, call it a year, maybe two, where it'll switch off and then go through this up and down protracted period, which can last. I mean, over in Perth, the economy is not as diversified over there. It's got a very high dependency on the mining sector, which is why it's not as stable and robust, which is why it can have these significant booms in the later half of the cycle where we're at, and then have a significant protracted and negative growth period in the first half of the next cycle. So that's why we're not buying in Perth. We don't suggest buying in Perth. Yes, you sure will make a quick buck if you go over there now. You want to flip a house or two, but I mean, you might as well go to the casino and start playing some roulette. It can go either way. So the risks to the downside is more and more higher as the market goes on. But unfortunately, like all these markets play out, a lot of people get sucked into the FOMO, the fear of missing out, and go charging in the later half of these growth runs and end up learning the hard way. So that's units. Perth houses a little bit more stable, but as you can see, they do have another strong year ahead, maybe two, but then they'll more or less top out and then go through a more subdued flat period, but not as negative and backwards as the units. So that's houses. Brisbane units, a little bit more stable compared to the Perth market, but as you can see, we're well away at the races with units, townhouses, villas in and around Brisbane, going gangbusters. And I believe, I mean, it's sort of starting to hit its limits, but we do have another year or two, or potentially three ahead before it will then top out and go through another protracted period of stagnant growth, like what happened between 2008 to 2022. So we were buying up a lot around Brisbane between 2018 all the way through to around 2023, which is when we stopped buying in that market, as we like to buy in around this period after a protracted stagnant period, as it is any time it can then hook into a growth cycle like what has happened over the last couple of years. As once the market has gone backwards and flat for 5-6 years, it's pretty much well tested. And that's when we like to enter the market after 7, 8, 9, 10 years of stagnant growth. So that is Brisbane. I'm putting units and houses in these slide decks this year. Getting a lot of people asking me around houses. Houses are great. I've got multiple houses in my own portfolio. And as you can see, they do perform similar to units. When the market starts to rise, it lifts all ships. So I'm an advocate for houses, but not necessarily going and ploughing into just houses, as you will definitely sacrifice on your yield when you go to a house. But then also when you buy a house, the banks look at them slightly differently. They put in different risk parameters when it comes to lending, as you're taking on the risk of the whole site. You have the risk of the whole roof and the structure, versus when you're in a unit complex, that risk is diversified amongst the unit holders. So that's a different positive to units that people don't necessarily understand what the banks want. And for the price of a house in the metro market, you can buy 3 or 4 units. So it's not about what it is. It's all about the price you pay relative to the intrinsic value. So that's houses for Brisbane. This is houses for the Queensland regions. As you can see, it's away at the races as well, and has a couple more years, but is more or less, it has started to look like it's starting to slow, which I've got a few properties out in regional Queensland, and I can feel it as well. I can feel the market starting to slow, but we'll continue to have growth, but then at some point we'll go through again another protracted stagnant period. So we're no longer buying in regional Queensland for that exact reason. Adelaide, I mean, Adelaide's pretty much off the charts. When a market starts going vertical, that's never a good sign. This is for units. And 2005 pretty much went flat. We had a bit of a run up in 2008-9, but then pretty well stagnant and flat. So I believe Adelaide's more or less at its peak. Sure, you might get another 10 or 15% growth, but it's pretty much hitting its limits. People think, Adelaide's still cheap. I mean, this on here for this specific suburb, units 400 grand median. Yes, that seems cheap compared to some markets like Sydney and Melbourne and Brisbane. However, each market needs to be looked at on its own merits, as markets do not continue to keep booming like this and go through 2, 3, 4, 500% growth year on year. They go through booms, usually 150 to 160, 70% capital growth, max 150, 60%, depending where you buy. If you buy right at the trough, comparing right at the peak, 180%, depending on the price you pay. But usually around 150% boom is its limit, and then it'll top out and then go through another stagnant flat period. It doesn't just keep running. The local wage does not support that price point, even though it may look cheap compared to other markets like Sydney. It will get a sugar hit with investment flowing in, all the FOMO, the interstate investment. But once the market tops out, it will soften and lose all that sugar hit, and then commence another flat, stagnant period. So another market we are looking to buy in the coming years. Houses in Adelaide, again, doing well, and we'll have another year or two of growth, but then more or less flatten out over a good 10 years ahead. Regional New South Wales, houses have had a solid run the last couple of years prior to the mid-cycle slowdown and throughout the mid-cycle slowdown. But the markets in regional New South Wales topped out in around 2022, and as you can see, has started its protracted stagnant period, which will last, based off history, another 10 or so years until the halfway through the recovery of the next 18-year land cycle, where people will then decentralize from Sydney and then look out into the regions again, when that will then perform like it has done over the last couple of years. So we're not buying in regional New South Wales. There's plenty of time. There's no rush. You're not going to get booming growth in the next 5 to 8, 9 years. So no rush on regional New South Wales for a house. That's why I say there's no rush, and especially don't go out and buying $1 million plus houses in Newcastle. It's a regional town. Don't get mistaken. Don't get fooled by the blue chip con artists out there who dress up all that stuff. You're going to overcapitalize. You're going to buy $1 million plus house in a region that is set to go through its next stagnant period of next to no growth. So what would you rather do? Buy $1 million plus house in the regions that is barely making a 5-6% yield, overcapitalized by building in a second dwelling in the back, having $1.5 million invested into one site, that's just making a 5 or 6% yield, or go and put that money to work harder in a block of units that will return 6, 7, 8% yields in markets that are set for growth, that have development upside by way of strata title, sell them off individually, or knock them down, go high density when the time comes. So that's just an insight of what I think, what you should or think or contemplate doing when it comes to spending $1 million plus. Look at blocks of units. Don't go spending, over $1 million on a house. It's not the best strategy. You get locked up with finance. Doesn't even if you're on 3, 4, 500 grand a year, big income, big shots. Don't get yourself tied up and conned into buying supposed blue chip, because every market goes through periods of stagnant growth and booms. There's not an asset that just continues to keep going on and on and on forever. So that's New South Wales regional houses. Similar story for regional Victoria. Topped out in 22 and has now started its protracted negative period, which will last another 5 to 6, 7 years. I mean, some people are getting excited going out to Ballarat and seeing it tick up. I mean, if you run certain reports, you can see it has ticked up in the last month or two. But that's a classic dead cat bounce. When a market softens, people will see value, or think, it's coming back, it's bottomed out. They then rush in. It has a bit of a run like that. But then it continues to go along its negative trend. So no rush on the regions in regional Victoria. Sydney houses. So yes, you can still buy a house in Sydney for less than 800, 700 grand. They're still out there. You got to know where to look, and you got to have relationships with real estate agents. You can get deals off market or pre-market, and you have buyers and backup buyers, and you've built a relationship with sales agents, you can get good deals. It's taken me many years to get good deals. And ever since starting this buyer's agent business, I'm getting even better deals, because I'm getting more activity, more transactions, and good deals feed on themselves and provide more and more opportunity. As when I buy a property, I tell the agent to go and speak to the whole street, the whole unit block, door knock, and if they've got another buyer or another seller who's willing to sell at a certain price, I'll have a buyer lined up. So that's how you can get quick deals at a good price if you move quickly and work with the sales agent. So yes, you can still buy deals for sub 800, 700, 800 in Sydney. You just need to know where to look. However, Sydney's got time, as you can see, between 2005 to really 2013. Sydney pretty well didn't go anywhere for houses, that is. The units, different story. Sydney units are due to soften this year and the next, but come 2027, they'll then start their growth run like what happened between 2007 and onwards to 2017. As you can see, it had that solid growth run in the first half of the current cycle, then had the stagnant period in the second half of the cycle. And then when the market turns into 2027, the market will recalibrate and Sydney, Melbourne will then lead again, like what history has shown us. So come 27, I believe Sydney units will be a performing asset. Melbourne houses, even better. As you can see, these graphs are starting to get a bit more stabilized as we go down. Melbourne has had a bit of a hard run the last couple of years, but that's opportunity. Is stagnant and will be stagnant for the next probably year to 18 months, and then it will commence its next growth cycle for houses in Melbourne. Same goes for units. I'm really excited on units. I think it's the best product to buy right now in the current market is units in Melbourne. As you can see, it's had a bit of a stagnant period the last few years. As the market topped out in 2017, 2018, has been up and down. We'll continue this year, but come 2026, it'll then be the leading market as what we've seen in history. So for the future years ahead. So buying in units in Melbourne, you've got to be cautious. Only certain types of products, certain types of assets in certain suburbs that will perform. it's not every unit. You can't just go blind and pick a unit and expect to get capital growth. And it's also down to the price you pay. So some people say, why use a buyer's agent if I know this information, go and buy it myself? Well, classic examples. Recently, someone was bidding on the same property as me a year or so ago. I secured the deal for 228,000. They had it for sale for 260, and the other person who found out later that I was the one that bought the property, put in offers for 240, 250,000, got them knocked back by the sales agent because the sales agent was saying he had offers at 250, 260. So how did I secure the deal for 228,000? Mystery. I'll let you imagine how I did that, but ultimately it's a relationship with the sales agent. It's also, you need to know what the sales agent says doesn't necessarily mean what the sales agent means. So they have certain prompts, certain cues, certain terminology they use to ultimately create urgency when there's not any, to ultimately drive top dollar for the seller. So they like to create almost an illusion that there's another buyer when 9 times out of 10 there isn't one. So if you know the game, if you know the tricks they play, you can save yourself hundreds and thousands of dollars in the long run. It's all about the price you pay relative to the intrinsic value. Don't just go out blind and just go and buy any unit in Melbourne, because it's not every unit, it's not every product, it's not every suburb, it's not every building, especially not the new and off the plan stuff. That's a great way to lose money. So that's units. Bit of a wrap up of where the markets sit in terms of the 18-year land cycle, where I believe they sit in terms of the historical sales data. Rates of January 2025. As you are probably well aware, as these markets are mainstream, Adelaide, regional Queensland, Brisbane, Perth are all going gangbusters. I mean, Adelaide's starting to slow. It's coming to its peak. It's pretty much at its peak. We'll top out in probably the next 6 to 12 months, and then we'll start to cool in the coming years. Regional Queensland's probably got another 2 or 3 years. We'll top out and start to cool. Brisbane, 3 years, I'd say. Perth, probably again 3 years, 3 or 4 years. But in the midst of the FOMO, all the stupid money, everyone's rushing in like what they do every time markets boom. But these markets now, we are no longer buying in because the risks to the downside is already there. They will correct, probably lower to where they are selling at these days. So especially if you go and buy new stuff off the plan, all the shiny stuff, you'll definitely be in negative equity the next 5-10 years if you keep buying these markets, especially in the regions. As when the market turns, come 2027, the ripple effect will come back. The ripple effect is already happening to regional New South Wales, regional Victoria. They're already topped out and starting to cool, as you saw in the previous slides. 2022, they topped out, and they're now 2 years into probably a 8 to 10 year period of stagnant flat growth. Whereas we have Sydney approaching the bottom in certain markets, certain products, certain suburbs. And the same goes for Melbourne. Melbourne's pretty much at the bottom, and the green shoots are already starting to arise. So we like to buy actively between low competition when the market is still slowing. So in Sydney, even though it is due to keep softening over the next 2 years, classic example, I was buying in 2024, last year, units in 1 and 2 bedroom units in Sydney for 310,000, 330,000, 340,000. Now it's very hard to get anything sub 400. So markets go up and down within 6 to 12 months. I'm suspecting over the course of this year and into next year, Sydney's going to soften. The deals will pop. It's only going to be a split opportunity, 6 to 12 months opportunity to get ultimate cracking deals before it'll then regain and commence its next growth cycle. So as the market continues to go down, there are these moments in time when they are the best times to buy. Best times to buy are coming into Christmas. So in spring is good time to buy because lots of people put their properties to market to sell because I think it's the best time to sell because of all the lighting. But the reality is when people flood the market with more stock, there's more options for buyers and you can get better deals. So spring and then out of spring, there's usually a glut left over from spring. And then coming into November, December, January, best time to buy. December, 1 or 2 weeks before December. And in that period between Christmas and New Year's Eve, I had 2 big solid months. Best time to get good deals because everyone's on holidays, everyone's checked out. No one can be bothered to commit to a large property transaction during that time that everyone wants to relax. Best time to buy. So there's a reduced amount of buyers in the market. There's a leftover stock from spring and urgency from the sellers because they want it gone by the time Christmas rolls around. So that's best time to buy. And as we come through, January, February, stock will start to get soaked up. March, April, stock is soaked up. And then the best time to sell is in June, July, because not many people like to put their properties to sell in June, July because they think it's a bad time with the rain, the weather, winter, cold, damp. Properties don't present the best. But the reality is because people hold back their properties to sell in June, July, August, there's less stock. The demand never goes anywhere. There's always demand to buy property. That's when the best prices are usually found, is in winter. So sell in winter, buy in summer. So that's a bit of a year ahead for the markets. I'll run these reports every month. We'll track them. If you want help getting a good deal, hit us up. I'll put my details in the comments below. As always, this is by no means financial advice or general advice, as I'm not a financial advisor. I'm a construction property guy who's been investing in the markets for many years, who has worked with the big institutions in property development. I look at property investing through a property development lens. I only buy property for half, if not a third of the intrinsic value, strong yields in markets that are primed for growth based off the 18-year land cycle in suburbs that will gentrify over time prior to all the infrastructure and all the bells and whistles and all the icing on the cake. That's the strategy in a nutshell. Shoot me an email, send me feedback, like, dislike, send it to your friend, colleague, whoever you would think would see value in this. Don't get caught up in the herd. It's emotional times. In the later stages of the cycle, there's typically a wealth divide. People who don't have property get the shits. People who have property are laughing for obvious reasons. It continues to go. People then get frustrated and throw their toys out of the cot and then rush into overheated markets and get taken out. Throw the baby out in the bathwash. So don't get caught up with the herd. Don't get caught up with the FOMO. Now is the most pivotal point of time to be very strategic and cautious with your investments, as not every market will be performing in the coming years. Not the mainstream, not the Perth, Adelaide's, Brisbane's, all the regions. They're due to soften and go through a downturn where the leading markets will be Sydney and Melbourne. If this resonates with you and you want help getting in the market and building a sustainable portfolio and navigating the market cycle and cutting a deal with the sales agents, I'm your man. Shoot me an email if you resonate with me and if you meet our criteria of the people we like to work with, who are motivated, willing to work to our strategy, just want to get ahead in life and build a solid residential foundation portfolio for yourself and your family. Hit us up today. I'll catch you on the next one.